As we have seen, different lenders use different measures when deciding whether to let you borrow money and on what terms. It's also common for some types of borrowing to involve more detailed credit checks than others. One potentially quick way of borrowing money over a short period is by asking for an overdraft from your bank or building society. This allows your account to go into a negative balance up to an amount agreed with your bank or building society. An interest rate is usually applied, with rates of around 15 to 20% being fairly typical. Overdrafts are normally only suitable for small amounts of money required for short periods of time. Penalties may be payable if you were to exceed an agreed overdraft limit. There are, however, many other ways of borrowing money that may be available to you. Let's look at some of these. Mortgages are a type of loan used to buy a home or other type of property. Mortgages often require the strictest credit checks, meaning that many people find they are refused a mortgage. The interest rates on mortgages are often lower than other forms of borrowing, with many mortgage rates currently varying between 1.5% and 4% a year. Personal loans are often provided by banks and building societies. Interest rates of between 3% and 6% a year are currently advertised. However, whether or not you are accepted for a loan and the rate of interest you pay will be determined by your credit score. Personal loans can often have payment terms that last several years and are generally intended for large one-off purchases. Car finance is often provided by car dealers to help customers to buy a car. The rates can vary widely, but interest rates of between 7% and 15% a year are currently common. Credit cards are available from a range of providers, including banks and building societies, as well as large retailers and supermarkets. Interest rates applied to credit cards are typically between 15% and 20%. However, they can vary a lot between different providers. In addition, a number of providers offer introductory rates, such as an interest-free period for a number of months or years. In-store finance refers to the borrowing that is sometimes offered at the point you pay for an item. This could be offered through a store card or through a loan offered by the shop assistant when you buy a large value item, such as furniture or electronic goods. An introductory offer may apply to these types of loans, which could include an interest-free period. Interest rates after these introductory periods have ended are generally high, with interest rates between 15 and 20% a year currently common. Payday loans are often the most expensive way of borrowing money. They're intended as short-term loans to cover a shortfall someone is experiencing until their next payday. This type of loan can be very expensive, with some lenders applying an APR of over 1,200%. Note that each of these interest rates for the different types of borrowing will vary in the future and could be higher or lower than we are showing here. After any introductory offer that may be made has finished, all forms of borrowing have an interest rate applied. Lenders can also apply other costs to a loan. That means comparing interest rates between loans may not give an accurate comparison of a loan's total cost. For more information about the importance of APRs, watch the APR Explained animation. Please be aware that the content of this video is provided for illustrative purposes. It is not intended to be used for financial planning and does not constitute personal advice. Whilst every effort is made to ensure the accuracy of information contained in the video, it cannot be guaranteed.